Stock futures falling after a new inflation gauge shows inflation. It's running hot again, not what you wanted to hear. NewsNation business contributor Lydia Moynihan joins us now. And Lydia, the Bureau of Labor Statistics says this is the largest rise in the producer price index since June of 2022. And that's when we hit that 40-year high of CPI inflation, which was over 9%. What is going on?
Yeah, it was not a good week for inflation data. So today we got the PPI, the producer price index. That's basically a measure of what retailers and manufacturers receive for raw goods. And so it's seen sometimes as a leading indicator of what we will all be paying down the line. We were hoping for 5.4% year over year. We got 6%, way hotter than expected. And this is after two other reports coming out this week, which are also much hotter than expected. The CPI report came out Tuesday, hotter than expected. Retail sales, hotter than expected as well. So we see futures not happy about this. But I do want to note, I think the Federal Reserve has been very cautious about how they've phrased everything. They've said it's not going to be a linear path of reining in inflation. We're going to have some bumps along the road. And that's clearly what this is. It is lower than last month, but it's not the dramatic decrease that we wanted to see when it comes to inflation.
Well, and last month, Jay Powell, the Fed chair, and the Fed, they decided, hey, we're only going to raise the Fed funds rate 25 basis points as opposed to the 75 we'd been seeing. So could we see a return to another higher interest rate hike? Because clearly inflation's not done with us yet.
Well, I think if you look at the rhetoric, they've been careful to say we're still going to keep rising rates, just not at the pace they were doing it. We were raising rates at aggressive pace we haven't seen in 40 years. And so we are still looking at, probably another 25 basis point hike in the next few months. And so I think he's kind of left the window open to the fact that we can continue to raise interest rates, just not as dramatically. And he said he doesn't expect to see necessarily inflation totally calm down in the next few months. He's sort of made it clear that he knows this is an ongoing battle, which is why, of course, we saw him hike interest rates 25 basis points and why he's continued to signal that he will hike rates for the rest of the year.
All right, Lydia, let's talk about cars now. A new report out from Cox Automotive found that the average new car payment, this is new cars again, in the U.S. is now $777 per month. Per month. That is rent in some towns. Are we at the point where buying a new car is just out of reach for the middle class?
I mean, it seems like it. And now even a used car payment is about $540 a month. That's higher by about $100 than a new car payment even just a few years ago. So I think a couple factors are at play. Obviously, we're talking about the Fed raising interest rates. Those interest rates are having a big impact on how much you're paying for your car. If you're not buying it with cash outright, you're going to be paying, 5, 6, 7% potentially on that car payment every month on top of that initial price. So that's one factor. And then the other factor is all of these supply chains have made it a lot more difficult to get a new car. And so I think we're seeing that reflected as well. It's higher interest rates, it's more difficult to get a car. And it's just wild. You speak with people who say, I can't get a car under $20,000 unless it's at least a decade old.
Thank you for watching. Go to newsnationnow.com to find NewsNation on your television provider. And don't forget to click the red subscribe button below to get more of NewsNation's fact-driven, unbiased coverage.